Hello, good afternoon, everyone. I would like to welcome all participants to this webinar organized by LTP Labs, which will focus on this title, which you are watching just now, Accelerating Analytics to Improve Market Understanding. I have to say that measuring has always been a key issue in marketing. Most people think that marketing is just a matter of feeling, of getting a flavor of the market and just deciding based on that. But no, we have always to measure performance, measure resources that are used in marketing, results, and so forth. The point is that things are changing now. And to understand the major changes and challenges that the companies are facing now in using, namely big data, on the basis of analytics, we have with us two speakers, and I will introduce them just now. Paulo Souza is Senior Manager at LTP Labs. Paulo works mainly with retailers, consumer goods companies, and telco operators. I have to say that despite his broad experience in supply chain planning, Paulo has lately focused on the application of analytical solutions to customer and marketing related challenges. Thank you, Paul, for coming. It is a pleasure that you will be with us, sharing your knowledge and experience. We also will have with us Pedro Campelo. Pedro is manager at LTP Labs. He has worked in multiple projects encompassing transportation optimization, customer loyalty, assortment management, and strategic marketing planning across many sectors such as retail and consumer goods. Throughout his work, Pedro has a particular focus on deploying analytical processes for marketing planning activities. So we have the right persons to talk us about analytics and the way we can use analytics in marketing and in the market context. I have to say that firstly, and I will address these words to the participants. If you have any questions, please use the BATPAP section. You can write your questions, and in the end we will have some time for questions and answers. And all the session will take roughly 1 hour. Our dear guest speakers will be in the first part, more or less 30 minutes, and the last 30 minutes we will give the floor to the participants in terms of their questions so that we can address them. And my first question, if you will allow me, I have this privilege of beginning questions. My first question is, why is analytics so important today, namely for marketing?
Mm-hmm. Carlos, first of all, thanks for the introduction. Indeed, and giving the motto for this for today's discussion, we believe that we are in the age of analytics, and indeed a lot of different renowned publications such as Harvard Business Review or The Economist or Forbes have talked about this analytics phenomenon recently, and there is a common understanding that there is a huge potential to unlock across business functions by using big data and by using analytics. But actually, we at LTP believe that when one of the areas of business where this opportunity is actually bigger is indeed marketing and sales, and that's why that's the focus of our conversation today. Don't you agree with that?
Yes, marketing and sales is a department or a function that overall is very customer oriented, right? So it's focused on the market, focused on understanding what are the business drivers behind customer choices, and this has always been very focused on customer information. And with digitalization trends and of course big data, as we were discussing before, the amount of data that and information overall that companies have on these topics is ever growing, right? And especially on customer level data, because right now with interactions with smartphones and personal devices, customer level information is even more available as well. And this type of information is something that is still relatively new to planning teams, especially in marketing and sales, and especially in high-level business decisions, because as we were discussing before, these are mostly focused on the experience of managers and decision makers overall. And why is data not being used throughout these processes nowadays? There are several challenges, and we would like today to discuss them with some more detail and to go through what actually should be done and some real cases that we have experienced, so we can also discuss them and bring insights from them as well. There are several challenges. First, the big data overall, it's hard to manage because it brings an additional layer of complexity and an additional layer of granularity as well. If we want to use customer level data, we have to be ready to make a lot of decisions and to really be thoughtful of the process that we use to actually make sure that all of the decisions make sense. All of this complexity still adds up to the fact that a lot of people that are making these decisions are not used still to handling big data, right? It's a relatively new technology, which is now quite common within training and within overall learning facilities, but it's still a challenge for teams to actually handle the data itself and to be able to use it. And what actually happens is many companies start having decision silos, right? And some teams have more expertise, some teams start building some analytical models, but then there is no coherent process throughout the organizations to actually handle these topics. And we believe this to be very important, especially when looking at these marketing and sales decisions. For example, looking at product definition, what product should we sell, what service characteristics should we define, the place and the channel planning exercise as well, how to define the price for the products, how to define our promotional environment, which is also so dynamic nowadays and so in need of profitability and to actually use the data that has already been generated to actually make these decisions. However, we do see that there are several topics here which we need to take into consideration, right?
In fact, what you have there in that orange square, it's what we call in marketing the key variables of the marketing mix. It is the 4 P's of marketing: product, place, price, and promotions. If we are talking about services in general, we have more 3 P's, which is people, processes, and physical support. But I think that maybe today we'll focus on these 4 basic variables. And I guess that maybe you can make clear to what extent analytics can help companies to improve product, to improve place decision, pricing, and even promotions. let us regard on product, which in general is the first key decision that companies have to take. How can we use analytics to improve product services so that they can be considered a good solution, a good experience by the customers?
Yeah. Indeed, Carlos, when we defined these, when we selected these 4 key decisions for which we believe that analytics can play a good role in helping business managers making more, let's say, more informed decisions, we actually select exactly as you mentioned, the classical four P's of market, to try to make here a bridge between what are such classical topics and this novel approach of analytics. And starting, as you suggest, with the product or service. Actually, product design is one of the areas where we believe that analytics is seldom applied. But we believe that still in this very, let's say, in this area where creativity plays a very big role, we still believe that a more data-driven approach can be helpful for business managers. And to illustrate that, we actually bring here a recent example in fashion e-commerce, where we used analytics to try to design a fashion delivery service by trying to understand what were the key drivers of client experience, and consequently what were the key drivers of client retention, of course, because an happy client is a client that remains with the company. And talking about this fashion delivery service, we identified immediately a lot of value drivers. For instance, speed. So, what is the lead time that we can offer to that the organization can offer to the client? There's of course convenience, and convenience can mean, for instance, consolidation. For example, if I order 3 different products, will the products be delivered in the same at the same moment, or will they be delivered at different in different timings? Of course, a consolidated delivery is more convenient for the client, but also can be more expensive from, let's say, from a supply chain point of view. We can also talk about the quality of packaging is another feature of a delivery service. And finally, of course, about price. And let's say that we are an organization that is planning how to deliver this service to its clients, and of course they they can invest in better features for this service, but they cannot invest in every one of them. So they have to make some options between these different value drivers. And exactly what we tried was to understand which of these drivers were more valuable for the client, were more interesting in terms of operational, even in terms of strategic interest. And for that, we actually grabbed a lot of historical data, millions of distinct purchases that were recorded in the recent past. And we looked at the behavior of the client after each purchase. And we tried to make some patterns emerge. So did a client that was better served, a client that that was served with more speed, have a better retention behavior than a client that received a better packaging when for the same order, or did the opposite exactly happen? And by comparing, so by looking at these historical data, looking at the characteristics of the service experienced by each client and and the ensuing retention. So did the client buy again? Did the client buy again very quickly, or did it take much longer for the client to buy again? We could then grasp what were among these, let's say, these value drivers, which of those were more relevant in terms of future demand. And by doing so, we can then inform in terms of strategic options by the company, where should, in which improvements to their service should they invest.
And I guess that this depends very much on the number of the database that you have.
Mm-hmm.
Because on the left hand side of your slide, you have millions of distinct purchases. Exactly. If it is 1 million, the accuracy, the capacity of forecasting is 1, but if it is 10 million, it will be much more higher, I suppose.
No, indeed. Of course, the accuracy of this kind of predictive analytics improves greatly when you have more historical data available. But in this marketing and sales area, typically we have most of our organizations have, let's say, a lot of detail about historical transactions. And by having data that goes down to the transaction level, so it's a very high level of granularity, then the application of this kind of approaches becomes immediately possible. possible. So that's why I think Pedro in the beginning was saying that indeed there is a very big opportunity for applying this kind of analytical approaches to marketing and sales functions.
And I suppose that after having an idea about the key features of your product or services, you have to design a way of delivering so that the customer can get the product or service in the right place at the right time, I guess, no?
Mm-hmm. Yeah, of course. Here we are talking of like, let's say, a decision step that happens immediately before execution. So of course, if we decide, for instance, that for us, for our client, and if we can recognize that from the data, that for instance, consolidation is more important than lead time, then we need to translate that into our operation, because of course the network, the delivery network, or the operation that we need to set up to ensure better consolidation or to ensure more precision in terms of the lead time is not probably the same operation that can ensure a very quick, let's say, or a very short lead time. So different operations have different advantages. So here we are talking, let's say, in a decision step a bit before, in which companies are deciding what is the priority for them, and they need to have an informed decision on that step. And then this is, let's say, this feeds the operational planning that comes downstream.
And the next step is place in the assortment, I guess.
Mm-hmm. Exactly. And regarding, Carlos, and regarding place and assortment, we also believe that analytical methods can have an interesting role there. And I would like to maybe separate let's say, two key discussions. So the discussion about place and discussion about assortment. So in terms of place, we are thinking about where should I sell my products? If I'm an organization, where should I sell my products? Thinking, for instance, from a retailer point of view, that would mean where should this retailer open its new stores? Then I need to decide if I decide that I will be present in, let's say, area E or area B, what is the assortment that should be available in each of those geographies. So that's, let's say, a second layer of the city. And starting by this first layer, so where should I sell my products? We typically, let's say, propose quite a structured approach to that challenge. So in which we have, and that approach has two steps. The first step is how to, we need to understand what is the market size in each geographical area with as much granularity as possible. Every detail, let's say, is important. And for that, of course, a lot of external data, say public statistics, market research, and so on can be used and can be combined, of course, also with internal data that in some cases is also available. And of course, by doing that, by combining these and consolidating this information, I can understand what is my, let's say, the size or the potential size of my market in every area, in every geographical area. But then I need to understand what share of the market can I capture by playing on that specific geographic area, and that of course depends a lot on competitive dynamics. And in particular, that's let's say, for understanding those kinds of dynamics, advanced analytics can actually play a very significant role, and I can actually illustrate that by presenting you a use case, a recent use case that we developed in food retail. So we followed exactly the approach that I was just mentioned. So we started by understanding what could be what is the size of the food retail market in every region of the country that we were looking at, and by that we knew the potential of each geographical area. But then we needed to understand what could be the market share that the retailer that we were supporting could capture if opening a store in a given location. And to analyze that, we looked also at data from all the other stores from that same retailer and try to understand why some of those stores sold more than others. What was the difference? Was it because competition was tougher? Was it because simply the market in those areas was not as big? So we tried to, let's say, process all this data. And from that analysis, what emerged were the let's say the drivers of consumer choice between different stores. And actually we could see that retail is mostly a matter of location, because the customer would in most cases decide its preferential store just by looking at distance. So the nearby store is the one that the most consumers will prefer. But of course, other factors such as sales area, such as brand, such as the context of the store. Is it a street store? Is it in a shopping mall? So all those characteristics of the store also play a role in customer choice. And so by, let's say, understanding that, we could then, for an hypothetical new store, we could then understand what would be what could be, by looking at that potential store, by looking at the competition nearby, we could understand what or predict what could be the market share that store could capture. And actually, by building that, let's say, that analytical model, we could not only make this work of predicting the sales potential of a new store more, let's say, more accurate, but also more efficient. Because of course, before using this kind of analytical method, one would need to go to the field to make a deep case-by-case investigation. And then with this analytical approach, one can reach a very good and precise estimate of the sales potential of a new store, actually in a very short time. This, of course, doesn't eliminate, let's say, the human experience and going to the field and looking at that location in particular, but can make that work much more productive. And so that's the first step, looking at the place. But then, if the retailer decides, okay, this is this potential location is interesting, then I will open a new store. Then the next step is to decide what should be the assortment available in that store. Right, Pedro?
Paulo, just one question. You are giving us an example of a new store. Without going much in detail, but can we use the same approach for an existing store?
We can, but actually when we do this kind of approaches, so let's say the main usage is to really understand what could be the sales potential of new stores and, let's say, guide these investment decisions and this expansion plan. But this methodology can be also applied for benchmarking around the existing stores. So what are the stores that are currently performing above or below expectations? And that actually can give a lot of insights also in terms of management. Where should the retailer invest more because the store could be selling more than it actually is? Or which stores are, let's say, the big success stories, and also they should be an example for the remaining network. So yes, the answer is yes, we can apply this to the current stores.
Thank you.
And
would you like to address at any point?
I would pick up on what Paulo was saying, and in the sense that planning our placement or the place overall, this decision for a retailer is mostly focused on, okay, where do I open the stores? What stores should I open, and what type of stores? We can also look at the problem from a more upstream perspective. And if we're the supplier of a specific product or a consumer goods company in particular, we also have to decide on what channels to focus, right? We have this portfolio of different products, different brands, different price positioning, and we want to see for each product, where should I sell it? What channels should I use to sell this product? And again, this is a topic that, of course, it's as usual a matter of matching or comparing the need for investment and our potential result, right? And by investment, we need to invest in distribution, sales force, promotion to push a product into a new channel. But then we need to compare that with how much demand am I going to generate? How much profit do I expect from that additional distribution in particular? And in order to figure that out, analytics really plays a very important role. This is because we can use data to really understand the drivers behind the purchase and the drivers behind a specific channel being successful or not. So if we're taking customer data in, and if we're really understanding how are sales being made, what are the drivers behind the customer choice, we can identify for each of the potential channels and outlets, including physical sales channels, online sales channels, we can understand what different types of consumer are using each of the channels. And we match those consumers with our own portfolio and the characteristics of the different products that we have. And by doing this match on a very, very granular level, we can really understand and fine tune this type of decision. Of course, for that, we need to understand the decision tree and the preference patterns for the different outlets. And we need to really understand as well what are the changes that might happen for consumption patterns for our consumers according to the channels that we eventually select. And bringing a specific use case that in which we were working with a consumer goods company operating in the Philippines, a market that has over 1 million outlets and that has a very large predominance of traditional retail. So small retailers that do not really have POS data, right? They do not have transaction level data, consumer level data. And what we worked with in this case was a massive survey was run through the actual sales force that was visiting these outlets to deliver stock, and to ask the outlet owners on an average basis, how much were they selling from the top products? This brought in a whole new level of information. So now we knew for all of these outlets, for these thousands of outlets, what were the products that were selling more at each one. And this allowed us to map the different customer preferences that each outlet has throughout the whole country. So we identified specific segments of consumers according to their different preferences. And then we mapped for different regions, what is how often we find an outlet from each specific cluster, let's say. And as we can see, these were very different. So some regions were more similar to the others, but we can clearly see that there is a different pattern across the different regions. But this was not the main finding, because we already knew at the start, right? There are regional preferences and some regions prefer some products over the others. The main finding was that even when we went on the actual route level, on the actual street level, we were finding outlets that have very significant, very different demand patterns. And why is this? Because the customer, the target customer of these retail small channels is actually a different customer. And this happens on many industries, many different business scenarios. Even if you have regional patterns, when you go to the store level and to the detailed channel level, there are different consumer characteristics that you need to target. And by doing so, we were able to develop an optimization engine that would actually look at each outlet in particular and select what are the matching products that we should really have in this outlet. And from the original outlets, we found that 300,000 had improvement opportunities, and this could translate into a 7% volume increase. So a 7% sales increase, which would be very, very significant without actually investing a lot, just by fine-tuning the actual assortment that we are, or the actual channels at which we are selling each of our products.
Yeah, I understand. Guys, so far we have talked about value. You elaborate on how analytics can help companies to design and improve their products, how analytics can help support companies in delivering their products. Maybe we can now talk about price. Can analytics also support companies in pricing decisions?
Indeed, Carlos, and price is a very interesting and also sensitive topic, because of course it's pricing decisions are very relevant not only for the competitivity of the organizations, but also for their profitability. And at LTP, we believe that even before let's say applying analytics to pricing, some relevant strategic thinking should be applied to the topic, and particularly to understand for each product that a given organization markets, what should be the right pricing approach, because of course different products have different characteristics and should then have different roles. And for instance, so using here a real example from electronics retail, one can find there different kinds of products. And for instance, we separate typically what we call the iconic products. So these are the items that drive the customer's price perception. So when, for instance, the smartphone. So when a given customer wants to buy a smartphone, as it is such an important decision for most people, what the customer will do is try to compare prices between different stores, between different retailers, even looking at prices in online retailers, and try to find, let's say, the cheapest option for the desired smartphone. And in those iconic products, what should happen is that, of course, the retailers should follow let's say, follow the competition, because if they have a higher price point, a price point that is clearly higher than the competition, then they will fall behind. So in those kind of products, analytics can still play a role in terms of cross-selling and so on, but it's a more limited role because retailers have, let's say, less degrees of freedom. On the other end, we have what we call the blind items. These are items that typically the consumers, the clients, they buy out of convenience, or they have, let's say, the kind of items where people have a lot of, let's say, impulse-driven acquisitions. So the price awareness and the price sensitivity is lower. And therefore, for those kind of items, and that could be, for instance, let's say the smartphone chargers could be a good example of that. For those kind of items, what the companies can do is really rely on analytics and on, let's say, on the classic elasticities, for instance, to try and understand what is the right price point, and therefore maximizing their own, let's say, their own margin. And so here the message, the key message is that different products with different characteristics should have different pricing approaches. And even in some cases, we need to combine pricing approaches. Sometimes we need to use margin, or there is an advantage in using elasticities to try to find the right pricing, but we still need to look at what the competition is doing. And I think Pedro will present an example in which that precisely happens.
Yes, when we're looking at pricing, and well, I think we can look at it in several different ways. We can look at it on a more reactive and operational day-to-day pricing activity of the products, but we can also look at it from a long-term strategic positioning place, right? So how I have my portfolio, what brands should I try to push as a premium brand? What is the different quality levels of my products, and to understand how I'm going to actually place these products in the market is also, in terms of price, is also a very important decision. And in this decision in particular, and I'm discussing here an actual example also from a consumer goods company. We wanted to build a model that would allow us to evaluate this pricing position. For this, we had first two main steps. One, to really understand the market. And going back to the start of our discussion, we need to bring in here macroeconomic data. We need to bring customer behavior data. We need to bring competition data as well. We need to bring all of the different lenses so that we do have a total market picture, so that we can then work on that. And that takes us to the actual issue of data sources. What information are we going to use? Because sometimes for companies, it's easy to use their own sales, from our products, right? We have them all in a database and all standardized, but it's really hard to merge the internal data that they have with external data and thick data from surveys, data from research, data from their actual business expertise as well. And bringing this all together is essential, especially when we're looking at a strategic planning model like this one in particular. So we had to bring all this type of data within the model. We had also to define the strategic landscape. What are the competitors? What are the different strategies? Some competitors are trying to increase market share because they're newer in the market. Some are more focused on profitability and ensuring that their results are profitable throughout the different years. And this really plays a role into what do I expect prices from the different competitors in the market to be in the future? Of course, to answer this, what we had to develop was an optimization model in which we would actually be evaluating different scenario for price movement. So along the time frame of decision, we would simulate and automatically calculate millions of different combinations of what player is moving what price, and then how are competitors reacting to that price change as well. And then by using the pricing, the price elasticity that we evaluate for different products, for different regions, for different customer segments as well, to really bring in the customer behavior part, we estimate what is the impact on demand, what is the impact on financial items. And by merging that all together, we have additional capabilities for strategic planning teams that they can automatically look at several scenarios that are different from one another, that are reliable and that make sense for the different strategies of the different competitors in the market, right? It's not an overly optimistic scenario. It's a scenario that makes sense. It's an equilibrium scenario, but we can focus then on analyzing what is more likely and how am I going to position myself to maximize the profit and to minimize the risk of the scenario not working out in our way. So I think this case was a very interesting case of using these different data sources, of understanding the different consumer types and how they react differently to the market to work in a strategic pricing as well.
Yeah, I would say that traditionally, most people still think to some extent that prices are established on the basis of the costs. But in fact, it is not. The costs are important just to know if I'm getting money or if I'm losing money. Because the big determinants of price are in the market. As you said, you have to look at information about competition, about consumer behavior, and about the positioning of the company. Now, I have here one question, because for the same product, in the previous slides, you have different types of products, more convenience products, more premium products, and so forth. But even from same type of product, or even for the same product, you can have different segments of customers, namely with different psychological or psychographic characteristics. It's not only a matter of age, of demographics, as you say, of economic information, but the way people think and the attitudes. Can you also capture these sort of things in relating to the sensitivity of price?
So I would say price is, as you are saying, a very interesting decision component, especially because there's a lot of psychological effects behind it. One of the most famous one being the price points, right? And having the 9.99 instead of 10, the difference that type of movement makes. So there are a lot of underlying features, and some of them are easier to understand from standard sales data than others. I would say something very interesting is how you can combine other sources like market research and consumer research, and which we actually did in this case in particular. So one of the sources that we were using was a choice-based conjoint analysis in which consumers were being shown a specific set of price possibilities, and then they would answer questions on their own consumer characteristics, on demographic information on the consumer. And then in the end, we could test out different price points that never happened in the market. So we could test the reaction of consumers to those price points and also correlate that same reaction with their own consumer information, right, and their own characteristics, which is very, very rich data to then extrapolate for other segments that we have are yet to target, or markets that we want to approach. So I think the beauty of using analytics here is really combining the hard sales data that we have and is very accurate with market research data that allows us to improve these decisions.
Okay, thank you.
Let me just add, Pedro, that regarding Carlos' question about how can we, let's say, differentiate price and between clients, and if we should do that. Of course, let's say the standard price is in many cases is common. Of course, physical retailers can differentiate price among stores. There are some degrees of freedom, but in many cases you will have the same, let's say, base price for every client. But I think that where you really can differentiate price is through promotions, particularly if you do, let's say, customized promotions. And by understanding your client, by getting to know your client, and you can use the available data for that, then you can, let's say, plan the right targeted, customized promotions. And I think that's a degree of freedom that really organizations can apply.
Okay, in fact, you are talking about price promotions, and this opens the door to the next point, which has to do with promotions in general, not only price promotions, but I would say marketing communication. Mm-hmm. Can I also use analytics to design a plan for marketing communication?
Yes, I would. The topic of promotions, it's even one of the topics that has more dynamic data, right? Because while some of the channel strategies and price strategies don't change a lot over time, when we're talking about promotions and how do I invest in pushing customers through the customer funnel, right, and the marketing funnel to raise awareness, to raise to promote consumers trying the new products. We're investing money in different dynamics, whether it's advertisement, whether it's a price temporary discount, whether it's a temporary extension of channels that we distribute the product to. We're investing and we want to measure the result. And as promotional activity has become so frequent throughout different industries and even industries that were not doing it so much before, there is a lot of data being generated on the actual results from the actions and the promotions. And we can do A and B testing. We can compare different promotions. We can compare the before, the during the promotion and after period to evaluate this uplift in sales and in efficiency. So we can compare with investment and then calculate our expected promotional ROI. And when we start looking at returns, then we start figuring out what promotions are profitable, what level should I stop at, and until when should I go in terms of measuring my investment, regardless of the channel, of the promotional channel, right? Regardless if it's advertising or placement within the retail or price promotions, for example. One case that we here on price promotions in particular, we were working with a food retailer, and we were gathering information on, well, the different consumers, the different purchasing history, the segments that they had, the promotions that we did before as well. And we were assembling this framework that was trying to decide on several different factors, right? What is our budget and how much should we invest? In what products should we actually promote? During what period, when and for how long, and to what people in particular, if we have channels to get to individual people and to really do targeted promotional activity. And by doing this, if we build a two-step model, one in which we are forecasting the customer reaction to a specific promotion, whether how much is it going to buy more, is it going to increase the frequency, is it going to increase the monetary value, so the different components of total purchases, what is going to be the impact on these components, so that we can then build the optimization decision model, right? So the analytical process of deciding on these various possibilities that I have, which ones are bringing me the most return on my investment. And of course, having a model like this allows us to do targeted promotional activity, which is more it has the potential, at least if done right, to be more efficient in the sense that we are targeting the consumers in which that activity is going to be, effective in raising their sales and their interaction with the brands. And we also get the ability to have forecasts on the impact, which are very useful throughout the organization for planning and operationalization for the different departments, right? So for example, a retailer, for stock planning, we need this information so to plan stock effectively. We can react to other competitor strategies. We can do A and B testing. We can do different promotions with different groups and use them to feed our model and to resharp our forecasts as well. And overall, really work towards optimizing the return on investment of these different activities.
Yeah, marketing communication is probably the area in marketing where you can, where it is you can waste money in the easiest way, because you just have to pay. You work with agency or so forth, and they organize a promotion campaign, and it costs you 500,000, 1 million, or 10 million, and you just have to pay. You almost don't have to work. If you want to change product, it's not so easy. If you want to change your distribution channels, it takes time and so forth. But in terms of communication, you just have to pay. And the point is, can you say let's assume that you are contacting a client, your client, and you can say, well, you can save this amount of money, or you can add this value to the sales or to the margin based on the use of analytics in promotion, in designing the promotion strategy. Can you say that?
I think the tricky part is evaluating the effectiveness of the promotion. And as you were saying, it's easy to run a promotion, right? And especially mass promotions, which you just, it's not easy because there's a lot of work behind it, of course. But to actually decide on building these promotions, it's easier than the rest of what we were discussing. And sometimes it's very hard to measure results, because especially when we're doing mass promotions, defining the control group and how are we going to evaluate if the change in sales was because of our promotion or because of other factors that were happening at the same time. And of course, this is a typical modeling correlation problem in which there are a lot of factors happening. And the more data that you have, the more you can distinguish between the different factors, of course. And I think this is where we're getting right now, is that many companies have a lot of history of running promotions. And by having a lot of history, they can really start looking at what they have done in the past. They can start projecting what they believe is going to happen in the future, and what research is guiding the information on how is the market adapting in the future. Merging those together, we can forecast the effectiveness of promotions. And by forecasting that, we can measure if they're profitable or not. And I think the overall movement of several industries right now is to be more detailed, not to run all promotions, not to run all programs that they think of.
Absolutely.
To pinpoint which ones are effective, because they see it as a good for raising profitability, right? Because there is a lot of money being spent in advertisement and in promotional programs overall that might not be effective.
Absolutely, absolutely. Now we are almost ending our nice talk, and so my final question has to do: how can we organize all of these so that we can develop, I would say, a framework for data-driven decision making? How can we put all together?
Mm-hmm. Yes. So I think going back to the start of our conversation, we were discussing that there are currently several challenges to actually embedding analytics within marketing planning overall. And one of those is the different silos. You have one team focused in price, one team focused in promotions, one team focused in channel organization, and each team sometimes is doing their own decisions. And that's the organization and the way that it's assembled. What is really important is for companies to be able to bring analytics into full corporate marketing and sales planning initiative. They need to be able to plan their actual market with all of these investments at the same time and looking at the different effects at the same time. Of course, doing this is not easy. This has to be done, this has to be a high level exercise for more strategic purposes, so for multiple year periods. And however, we need it to be detailed. And if we want to use analytics, we can use analytics to make it very detailed and to make it bottom up. So despite the decision being high level, we can make it bottom up. For that, of course, we need to collect data. And the data is what we have been discussing, very different data sources. We cannot do this with only our internal sales. We need to have estimates for what is the total market, what are competitors doing, what products do they have and what prices and what promotions are they running. As well. We need that full vision so that we can then design scenarios, and this we start getting into a more future thinking point of view. We need to design scenarios of what can happen so that we can use our models, our data and our business sense as well, which is very important in strategic topics, to forecast the impact of these different scenarios on different metrics. We need to validate, adjust. There needs to be a team that is responsible for future scenario planning so that they can then approve scenarios, discuss scenarios with stakeholders. And what companies normally do is they have one or two scenarios that they go to. They have one master plan for the next few years. And using analytics and bringing data into this process really enables them to generate many scenarios, multiple scenarios, because the forecasts start running really fast. They start being very accurate because they're taking into account all of this information. And then stakeholders are able to look at different scenarios in terms of their own strategy, in terms of competitor strategy, in terms of demographic evolution as well, and really plan for the future, having a very detailed forecast, having the evaluation of different effects simultaneously, which is very beneficial as well. It makes it easier to define targets for sales teams, for marketing teams as well, because you know in what is your overall strategy and what is the effect that you want that team to be responsible for. And it makes you more agile in planning, which is very important. This strategic planning is also in many companies, it's done once a year or once a quarter. And companies should move into a more dynamic point of view. They don't need to change their plan all the time, but they should be able to react really fast to when something happens. And I think right now we're just going through the best example of that, like something predictable that with the pandemic effect that happens and no one is ready, no one anticipated that. And changing of this strategy really fast is a very, very important feature that analytics really helps in doing.
Thank you.
Yeah, Pedro. Just to complement what Pedro was saying, I totally agree that having, let's say, a structured and agile framework is very important in terms of strategic market planning. But then sometimes there are, let's say, novel and unpredictable events that arise and that really can shake things up. We are experiencing just that with this pandemic that we are all going through. And as Pedro was saying, in those cases, of course, we need some kind of more ad hoc analysis, but still we can be data driven. Still, we can use data and analytics to help us, let's say, going through that, let's say, that uncertainty. And just to illustrate that, just recently, a consumer goods company asked us how to, let's say, to model the market, or how would market development unfold after the COVID-19 pandemic. And we, of course, needed to set up an analysis dedicated to this topic, but we tried that as much to leverage data that we could reach and that could be helpful for us to, let's say, define those 1, 2, 3 key scenarios that Pedro just talked about. And actually, we could look at a lot of different effects. We could look at behavioral changes. So we know that when a pandemic like this happens, this will impact how consumers react, and will impact their preferences. It will impact what they are more inclined to buy, and to make sure that we could incorporate that in our projections for the market. We try to make, let's say, the decision support models more reactive, and immediately look right after the start of the pandemic, immediately look at the sales trends, and for instance, identifying what were the products and the product categories that were growing more significantly, or that on the opposite end were decreasing. And by looking at that data, we can frame this behavioral change from consumers, and then translate it to the scenarios that we are trying to project. Also, there's of course a macroeconomic effect, as we all know. With the pandemic comes unfortunately an economic recession, and to understand what could be the impact on a given organization of that recession, we can of course use external data, and a lot of let's say market research organizations are doing a lot of estimations on how the economy in each market, in each country will evolve, and we can cross-check, let's say, compare those estimations and with the data, internal data from previous economic downturn. So what happened, for instance, 10 years ago in the past, in the latest crisis before this one, what happened in terms of sales patterns and so on. And we can try to leverage that data from previous recessions to understand what could be the impact of this recession on our business. And finally, we decide not only to look at, let's say, more behavioral changes and economic impact, but also looking at regulatory changes. And for instance, for certain products, they are, let's say, sales are very driven by tourism or by, let's say, cross-border sales. For instance, when taxation is very different between countries and people tend to go to the nearby country to buy product A or product B. And we can grab data from those kind of phenomena, and then by looking at those numbers, we can forecast in a quite precise way what can be the impact, for instance, of travel restrictions. And we know that tourism was kind of interrupted for a few times, and we can understand what will be the impact in each internal market of those travel restrictions. And so there are a lot of effects. We need, of course, initially from a qualitative standpoint, to do some kind of brainstorming, understanding what are the effects that we should take into account. But then for each of these effects, even if it's something completely new, still a data-driven approach can help us have better projections of what will happen, and then of course making better decisions.
Thank you very much. We are just on time. I have here a few questions, and so that we can answer these questions, I would ask you something which is not easy to deal with, which is to answer in 30 seconds. And one of you choose. Each question is answered by just one. Well, let us look at the first question that I have here. What type, well, I'm not so sure if you can answer in 30 seconds, but what type of data do you need to understand the consumer preferences?
Okay. consumer preferences in the sense of different characteristics of products that we want to measure. We can look into that one from transaction sales, like which products are selling more and which products are selling less. But to make that a richer data set, we can also involve consumer research in the sense that we can ask directly consumers what they feel of different products, of different characteristics, what do they value, and we can use that information as well to measure these types of preferences from consumers.
Okay, thank you. I have here a question about pricing, which is, it is a key issue. I would say that does not apply only to pricing, but the question is focused on pricing. How do you decide the point when you evaluate where to keep or to change a pricing strategy?
Trying to answer very, very quickly. I think that really is a critical question. And one can think of some flags that some automatic flags that we can set up that allow us to identify when a given product we might not be following the best strategy, the best pricing strategy for a given product. But to ensure that we have a more structured approach to the problem, what we typically propose is that let's say 2-3 times per year, that depend that these, let's say, this periodicity can be adjusted case by case, but that 2 or 3 times per year, one can the marketing team or the price planning team can go back to this exercise and, let's say, rethink for the whole assortment, for the whole product range, what should be, in which basket should each product be inserted. So we think that should be done, let's say, periodically in a structured fashion. That is the best approach, because actually deciding, let's say, the best pricing approach is not something that we can do live. We need to decide the price almost live, of course, and we need to have, let's say, the analytical engines for that. But deciding in which, let's say, major pricing approach should we insert each product is something that we can do 2-3 times per year. Of course, that depends a lot on the sector in which we are operating.
Thank you very much. I have here another question which combines communication with distribution. And the point is, how can you optimize the communication among channels? In fact, as far as we understood, you can optimize communication in one channel. But how can we optimize among all channels that the company uses?
Mm-hmm. So optimizing the communication, specifically communication to consumers, I think there are 2 major answers to this question. Some types of communication work better in specific channels. And I think this is something that we can use analytics to evaluate which communication works better for each specific channel. And also, specific customers might react better to communications in specific channels as well. So there's also a customer preference sense here that is important to evaluate. And I think data and analytics help evaluating this both, looking at the customer, what is the best channel to contact this customer, and also looking at the message, what is the best channel for this communication message as well.
Just to add to what Campbell is saying, in fact, there is a key challenge here because, for instance, talking about communication, when we are talking, for instance, communication in terms of TV, typically what you have is these growth rating points that evaluate if you are reaching your target audience or not. While, for instance, when we are talking about, let's say, online communication, these online campaigns, we are talking mostly about clicks. And so these are different metrics, but one of the challenges that we have in those kind of topics is initially to try to understand how these different metrics that evaluate our performance in the different channels can be translated into a, let's say, single comparable metric. It could be sales, it could be something else, but we need to firstly do that exercise and after that, then these more, let's say, analytical optimization methods can be applied to this problem.
Thank you very much. I have here, I would say it is a €1 million question, but I will leave that for the end. Now I have a question which combines distribution with pricing, and it has to do with omni-channel strategies. The question is, with more omni-channel marketing organizations, that is companies that have an integrated or offer an integrated experience in different distribution channels, what is the place of different channel pricing policies? How can we combine different pricing policies for an omni-channel company?
So I think that's quite a complex topic, but to try to be very brief, actually we presented a framework in which we were trying to find for each type of product what could be the best pricing approach. And we said that that is like, let's say, a strategic reflection that we can do before we apply any kind of analytics. When we are working in a very omni-channel reality, we need to do just that, but not looking only at the product dimension, but looking at the combination between product and channel. And we need to understand for each combination between product and channel, what is, let's say, the role of that product in that given channel, and that role then translates into an ideal pricing approach. That of course makes the exercise more complex, and we will talk a lot about that. But actually having these, let's say, this omni-channel setting, an omni-channel mindset in our approach, that should start right from this more strategic thinking phase.
Okay.
Well, just adding very quickly that I think analytics also helps into figuring out whether omni-channel strategy for pricing makes sense or not. Because there's a trade-off between having the same price across channels, improving the experience for users and avoiding them looking online while at the physical store and finding that there is a different price, for example. But at the same time, you can use analytics to value how much would I gain from dynamically setting my price, and then using that as well to make the strategy decision.
Thank you. And now it is a very, very important question, because we have heard all that these ideas that you shared with us. And now if I think, well, and for small companies that do not have large marketing teams, that do not have lots of money to spend, how can they have access or use these sort of approaches that you have just described us?
Okay, so I think that's actually also a big challenge. How to apply these to smaller companies. Of course, there is something that comes first. These companies need to have access to data. They need to have some kind of, let's say, information system. They need to have transactions recorded. Of course, that's a very important requirement. But after that, even if they have a very small or lean organization, I think that still these approaches can be applied. Of course, I think that we need to set our priorities right from the start. Maybe they cannot tackle all these different topics that we just mentioned. They need to prioritize, but because they are, of course, a smaller organization, maybe not all of these topics are relevant, let's say. So we really need to, let's say, promote some kind of focus. And by doing so, and provided that the data, so that's our, let's say, that's the key requirement. Provide that the data is is available, then this kind of methodologies can be combined. And of course, these methodologies, they always, as Pedro was explaining a while ago, they always imply some kind of interaction between, let's say, more automatized tools and, let's say, the human touch. Of course, if the marketing team is smaller, probably we should invest more beforehand in making the process as automatized as possible, because people from the marketing team won't have so much time to spend in further optimization. So we need to calibrate our approach, taking that into account. But still, it can be done, provided that the right data is there for us to use it.
Okay, thank you very much. Thank you, Paulo. Thank you, Pedro, for sharing with us your knowledge, your experience. And I have to congratulate LTP Labs for organizing this sort of webinars, and in particular this one. And for me, it was a great pleasure and honor being here with you both, Paulo and Pedro, and with participants that have attended this webinar. To all of you, thank you very much and enjoy your afternoon. Thank you very much.
Thank you.
Thank you.